Over the past year, the world of investing has been turned upside down by a new phenomenon, which is meme stocks. These are stocks that gain popularity on social media and online forums, often driven by individual investors rather than traditional financial institutions. GameStop and AMC are two of the most famous examples of meme stocks, with both companies experiencing incredible surges in stock prices that made headlines around the world. At the heart of the meme stock phenomenon is the power of social media and the democratization of investing. Thanks to online forums like Reddit's wallstreetbets, individual investors have found a way to band together and drive up the prices of certain stocks, often targeting companies that have been heavily shorted by large institutional investors. In the case of GameStop, the stock price rose from around $20 to a high of over $400 in a matter of weeks, leading to massive losses for short sellers and huge profits for those who got in early. But the GameStop saga was not without controversy. Some accused the wallstreetbets community of market manipulation, while others questioned the long-term sustainability of the meme stock phenomenon. The fact is that meme stocks are a new and unpredictable force in the financial world, and their rise and fall raises important questions about the nature of investing, the power of social media, and the future of the stock market. In this video, we'll take a closer look at the rise and fall of meme stocks, with a focus on GameStop, AMC, and other key examples. We'll explore the economic and market forces that contributed to the meme stock phenomenon, the risks and challenges of investing in meme stocks, and the potential regulatory response to this new form of trading. By the end of this video, you'll have a better understanding of the economics behind meme stocks and the implications of their rise and fall for investors and the financial industry. So let's dive in and explore the fascinating world of meme stocks. The GameStop saga is perhaps the most famous example of the meme stock phenomenon. It all started in early 2021, when a group of individual investors on the wallstreetbets forum on Reddit began buying shares of GameStop, a struggling video game retailer that had been heavily shorted by institutional investors. The short sellers had bet that GameStop's stock price would go down, but the wallstreetbets investors saw an opportunity to squeeze them out of their positions by driving up the stock price. And drive up the stock price they did. GameStop's stock price began to soar, rising from around $20 per share in early January to a high of over $400 per share in late January. The surge in stock price led to huge losses for short sellers and massive profits for those who had bought in early. The story made headlines around the world, with many investors and commentators marveling at the power of social media to upend traditional market dynamics. But the GameStop saga was not without controversy. Some accused the wallstreetbets community of market manipulation, arguing that the coordinated buying and pumping up of GameStop's stock price was unethical and potentially illegal. Others pointed out that the surge in GameStop's stock price was unsustainable and that many of the investors who had bought in late would ultimately lose money. Despite the controversy, the GameStop short squeeze was a powerful example of how individual investors can band together and disrupt traditional market dynamics. It also highlighted the risks and challenges associated with investing in meme stocks. While some investors made huge profits from the GameStop surge, others lost money, and the stock price eventually fell back down to more reasonable levels. But what were the economic and market forces that contributed to the GameStop surge in the first place? One factor was the heavy short interest in GameStop stock. Institutional investors had bet heavily against the company, believing that its business model was outdated and that its stock price would continue to decline. But when the wallstreetbets investors began buying up shares of GameStop, they created a demand that the short sellers couldn't meet, leading to a rush to cover their positions and ultimately driving up the stock price. Another factor was the power of social media. The wallstreetbets community on Reddit is known for its irreverent and often humorous take on investing, and the GameStop short squeeze was in many ways a reflection of their collective desire to stick it to the big institutional investors who they felt had been exploiting the market for too long. The use of online forums and social media to coordinate buying and driving up of GameStop's stock price was a key factor in the success of the short squeeze. In the end, the GameStop saga was a powerful reminder of the potential for individual investors to disrupt traditional market dynamics. It also raised important questions about the role of social media in investing, the ethics of coordinated buying and selling, and the risks and rewards of meme stock investing. While the GameStop short squeeze may have been a one-time event, its impact will be felt in the financial industry for years to come. The GameStop saga may have been the most famous example of the meme stock phenomenon, but it was far from the only one. Another company that saw a surge in stock price thanks to coordinated buying by individual investors was AMC Entertainment Holdings, the world's largest movie theater chain. Like GameStop, AMC had been heavily shorted by institutional investors, who believed that the COVID-19 pandemic and the rise of streaming services had made the movie theater business model unsustainable. But in early 2021, the wallstreetbets community on Reddit began buying up shares of AMC, creating a surge in demand that sent the stock price soaring. At its peak, AMC's stock price rose from around $2 per share in January to over $70 per share in June. The surge in stock price led to huge losses for short sellers and massive profits for those who had bought in early. It also led to a wave of excitement and optimism among individual investors, many of whom saw the AMC surge as a way to take on the big institutional investors who had long dominated the market. But as with GameStop, the AMC phenomenon was not without controversy. Critics accused the wallstreetbets community of market manipulation, arguing that the coordinated buying and pumping up of AMC's stock price was unethical and potentially illegal. Others pointed out that the surge in AMC's stock price was unsustainable and that many of the investors who had bought in late would ultimately lose money. Despite the controversy, the AMC surge was a powerful example of the potential for individual investors to disrupt traditional market dynamics. It also highlighted the challenges and risks associated with investing in meme stocks. While some investors made huge profits from the AMC surge, others lost money, and the stock price eventually fell back down to more reasonable levels. One factor that contributed to the AMC surge was the heavy short interest in the company's stock. Institutional investors had bet heavily against AMC, believing that the pandemic and the rise of streaming services had made the movie theater business model unsustainable. But when the wallstreetbets investors began buying up shares of AMC, they created a demand that the short sellers couldn't meet, leading to a rush to cover their positions and ultimately driving up the stock price. Another factor was the power of social media. The wallstreetbets community on Reddit was instrumental in coordinating the buying of AMC's stock, and their use of online forums and social media helped to create a groundswell of support for the company. The excitement and optimism among individual investors helped to drive up demand for AMC's stock, even as the broader market remained skeptical of the company's prospects. The AMC surge also raised important questions about the role of social media in investing, the ethics of coordinated buying and selling, and the risks and rewards of meme stock investing. Like the GameStop short squeeze, the AMC surge was a reminder of the potential for individual investors to disrupt traditional market dynamics. It was also a cautionary tale about the risks and challenges associated with investing in meme stocks, and the need for individual investors to carefully weigh the potential rewards against the potential risks. The rise of meme stocks like GameStop and AMC has challenged traditional economic models and highlighted the power of individual investors in the market. At their core, meme stocks represent a new form of market disruption, in which social media and online communities play a critical role in shaping market demand and driving up stock prices. One key factor behind the rise of meme stocks is the concept of a short squeeze. Short selling is a common practice in the stock market, in which investors borrow shares from a broker and sell them with the intention of buying them back later at a lower price. If the stock price does indeed fall, the short seller can buy back the shares at a lower price, return them to the broker, and pocket the difference as profit. However, if the stock price rises instead of falling, short sellers can find themselves in trouble. They are still obligated to buy back the shares they borrowed, but now they must do so at a higher price than they sold them for. This can lead to a rush to cover short positions, in which short sellers buy back shares en masse to avoid further losses. This buying can create a surge in demand that drives up the stock price, in what is known as a short squeeze. The short squeeze is a key factor in the rise of meme stocks like GameStop and AMC. In both cases, institutional investors had bet heavily against the companies, believing that their business models were unsustainable and that their stock prices would fall. However, when individual investors began buying up shares en masse, they created a surge in demand that forced the short sellers to cover their positions, driving up the stock price even further. But the economics of meme stocks go beyond the short squeeze. At their core, meme stocks represent a new form of market disruption, in which social media and online communities play a critical role in shaping market demand and driving up stock prices. The rise of meme stocks is a result of the democratization of information and the rise of social media. Individual investors can now easily access information about stocks and share their opinions and ideas with others in online communities like wallstreetbets. This creates a powerful network effect, in which the collective actions of a large group of investors can have a significant impact on market demand. However, the rise of meme stocks also raises important questions about the ethics of market manipulation and the sustainability of the stock market as a whole. Critics of the Wall Street Bets community argue that the coordinated buying and pumping up of stock prices is unethical and potentially illegal. Others point out that the surge in meme stock prices is often unsustainable, driven more by hype and speculation than by any real change in the underlying value of the companies involved. The economics of meme stocks also highlight the challenges and risks associated with investing in individual stocks, particularly those that are subject to wild fluctuations driven by online communities. While some investors have made huge profits from meme stocks, many others have lost money, and the long-term sustainability of these investments remains unclear. Ultimately, the rise of meme stocks represents a new chapter in the ongoing evolution of the stock market. It is a reminder of the power of individual investors to disrupt traditional market dynamics, and a cautionary tale about the risks and challenges associated with investing in this new and unpredictable market. As the market continues to evolve and new forms of market disruption emerge, it will be up to investors, regulators, and market participants to adapt and navigate this new landscape with care and caution. The rise of meme stocks has caught the attention of regulators and lawmakers, who are grappling with the new challenges and risks associated with this type of market disruption. While there are currently few regulations specifically addressing meme stocks, regulators are closely monitoring the situation and considering new rules to prevent market manipulation and protect investors. One key challenge for regulators is defining what constitutes market manipulation in the context of meme stocks. While some forms of market manipulation, such as insider trading, are clearly illegal, it is less clear whether coordinated buying and pumping up of stock prices by online communities like Wall Street Bets is illegal or unethical. In response to the GameStop saga, the SEC has launched an investigation into potential market manipulation and has promised to take action if any laws have been broken. However, the outcome of this investigation is still uncertain, and it remains to be seen whether regulators will be able to effectively address the new challenges posed by meme stocks. One potential approach to regulating meme stocks is to require more transparency and disclosure from companies and investors. For example, the SEC could require companies to disclose their short interest, or the percentage of shares that have been sold short, to provide more information to investors and prevent short sellers from taking overly risky positions. In addition, regulators could require online communities like Wall Street Bets to disclose their affiliations and potential conflicts of interest, in order to provide greater transparency and prevent coordinated market manipulation. However, implementing such regulations would be a complex and challenging task, and could face pushback from the online communities themselves. Looking to the future, it is likely that meme stocks and other forms of market disruption will continue to be a significant force in the stock market. The democratization of information and the rise of social media have empowered individual investors and made it easier for them to coordinate their actions and disrupt traditional market dynamics. However, it is also likely that the stock market will continue to evolve and adapt to these new challenges. Regulators and market participants will need to remain vigilant and proactive in order to prevent market manipulation and protect investors, while also allowing for the continued evolution and innovation of the stock market. The rise of meme stocks represents a new and unpredictable chapter in the ongoing evolution of the stock market. While it has challenged traditional economic models and highlighted the power of individual investors, it has also raised important questions about the ethics of market manipulation and the sustainability of the stock market as a whole. As the market continues to evolve and new forms of market disruption emerge, it will be up to investors, regulators, and market participants to navigate this new landscape with care and caution, and to ensure that the stock market remains a fair and transparent playing field for all investors. The rise and fall of meme stocks has been a fascinating phenomenon to watch, with GameStop and AMC leading the charge in a new era of market disruption. These stocks have shown the power of online communities, the importance of transparency and disclosure, and the need for vigilant regulation in the face of new challenges. The GameStop saga was a wake-up call to many investors, highlighting the risks and opportunities associated with short selling and coordinated buying. It also brought attention to the potential for market manipulation and the importance of clear regulations that protect investors and maintain market integrity. The AMC phenomenon showed the power of individual investors to drive stock prices and create new opportunities in the market. By banding together and sharing information, retail investors were able to make significant gains and challenge the traditional power structures of the stock market. The economics of meme stocks are complex and multifaceted, with factors such as short interest, supply and demand, and investor sentiment all playing a role in driving prices. While some investors have made significant gains from meme stocks, it is important to remember that these gains are often short-lived and driven by unpredictable market forces. Looking to the future, it is clear that meme stocks and other forms of market disruption will continue to be a significant force in the stock market. The democratization of information and the rise of social media have empowered individual investors and made it easier for them to coordinate their actions and disrupt traditional market dynamics. However, it is also clear that regulation and oversight will play an important role in shaping the future of the stock market. Regulators will need to remain vigilant and proactive in order to prevent market manipulation and protect investors, while also allowing for the continued evolution and innovation of the stock market. Overall, the rise and fall of meme stocks has been a remarkable and unpredictable journey, with important lessons for investors and regulators alike. By understanding the dynamics of the market and staying informed about new developments and trends, investors can continue to make informed decisions and navigate this rapidly changing landscape with confidence and clarity. Thank you for watching this video on the rise and fall of meme stocks. We hope you found it informative and insightful. If you enjoyed this video, please don't forget to like and subscribe to our channel for more content like this. And if you have any thoughts or feedback on this topic, we'd love to hear from you in the comments below. Thanks again for watching, and we'll see you in the next video.